Hey guys, Freaky Finance here. Last week we looked at Rick's Hospitality, and this week we're gonna look at Blackrock. Blackrock's a fun one. Listen to their conference call today for Q3, and I figured, you know what, I'm gonna just do a video on them because I've been tracking them for so long. I think I've done financial ones before. This company is pretty unique. I mean, I've done power, which is probably more complicated than this business because it's a holding company of a bunch of businesses, whereas Blackrock's pretty, in my mind, it's actually simpler than either a Brookfield or a Power would be, which I own. But I don't own Blackrock yet, and I'm thinking about getting into it. So I wanted to do a video ahead of time, especially if, like, say a recession happens. It's kind of one that I've been wanting to buy for a while. Just never gotten that right value for a pretty strong business. So anyway, Blackrock's business is really fees. So on the conference calls, I'll talk about a bunch of different stuff. At the end of the day, it's just assets under management fees. So say if you have $10 trillion under asset management, you earn about 18 billion in revenue. Your fee is basically 18 bips or 8.18%. And that's just kind of how I view Blackrock. So the bigger the markets go up, Blackrock's going to do good. And there's another thing here is that as ETFs continue to take share from mutual funds, you should also continue to see BlackRock do well. And that's a trend I think is just going to keep happening over time as people eventually wake up and stop paying 1 to 2% mutual fund fees when they can just do something similar with a bunch of ETFs, or like a basket of ETFs. You can do pretty much the same thing. So I just think that's a no-brainer over time, and I think the share price partially reflects that, but it's also the business over time has done quite well for itself. There's a reason why the share price has just slowly gone up and to the right. It's because the performance has been there. So what I mean by that, just quickly, this is on the latest quarter. I didn't make my own financials for this one. This would be a quicker video because I'm just trying to, I want to listen to myself again after the fact, especially if this ever gives me a shot when it gets cheaper. Anyway, you can see the margins here, just outstanding. So you're getting 1.6 billion in operating income for only 4.5 billion in revenue, and it's a very clean number. The balance sheet's very clean. Well, they have debt, they have net cash actually, so the balance sheet's pristine for these guys. They buy back a decent amount of the company over time and pay a pretty good dividend. So anyway, who uses BlackRocks? I do. Wealth management funds do, pension funds do, insurance companies, institutions do. You can see here, it's kind of a noisy chart, but you can see institutions are quite a bit of their percent of AUM, assets under management, but they're only 30% of their fees, whereas retail is only 10% of their AUM, but they're 28% of their fees. Specifically, someone in retail may also correlate with someone who's using alternatives more, which again, here you can see very easy. AUM for alternatives is only 3%, but alternatives are 11% of their base fees. So you can see the fee structure for an alternative fund is much higher than, say, a fixed income fund, or fixed income ETF rather. That's just kind of how I view BlackRock. One of the ways that they're trying to get higher fees is by trying to funnel more assets into their alternative funds. And here you can see another way to show that. You can see alternatives growing on a 16% 5-year CAGR, whereas, say, equity and fixed income are just growing around 6%. Again, pretty good growth rate over time. It's a very steady grower, and it also moves up and down with the market. So, like, when the market corrected in 2022 versus 2021, we saw their earnings per share go down, and markets generally go up over time, over a long time horizon. So generally, BlackRock has appreciated with the market as well. And this is a scale game. So the bigger you are, the more you can scale off your employee headcount and your tech structure, your marketing spend, your general overhead. Just, it's a really easy business to scale over time, especially when you already have 10 trillion in assets like these guys are approaching again. They actually hit it in 2021, but the market's tanked and they went down to 8.5 the year after. And you can see it's largely equity and fixed income. And there's a specific reason I'm looking at this company now, and I'm going to go into it at the end of the video. But it's another catalyst of why I'm hoping to get into it during a pullback, especially if there's a recessionary fear pullback and the multiples and everything just go down. I think this is going to be one of the easiest buys that I can make at that time. And that's why I want to get this video out ahead of time, so I'm in a position to do just that. In terms of where the assets are located, you can see they're still dominated in Americas. They have a little bit of exposure, 2 trillion in Europe, and very little relative to the net wealth in Asia. So I'd say they have a lot of room to run. You might be like, well, I mean, they already have $8.6 trillion in AUM. What do you mean? There's over $100 trillion in AUM out there. I mean, they're probably only, I think they have an actual chart that shows that they're pretty small relative to the overall market of asset managers, even though everyone's heard of BlackRock by now. And one of the cool things with BlackRock is that you can see net inflows here consistently taking inflows, even when mutual funds are selling and everyone's leaving them because they've been performing so badly, especially balanced funds. You can see that ETFs just keep taking share, and that's because it's superior structure. And I'm going to go into that real quick here with an example. Especially in Canada, ETFs are just far superior to mutual funds. The mutual fund industry in Canada is just out to whack in terms of their fees. And you also get this nice appreciation from just being a superior vehicle for investments. And then you get this slow and steady, well, I guess I wouldn't put it steady, but you get this slow appreciation in markets over time, which is a net positive as well. As markets go up, their fees go up because it's a AUM percent fee based. Markets appreciate, they get paid more money on the same amount of costs. So the scale is just so good when markets go up. And obviously the reverse happens when markets go down. It tends to move with the market, which I'm hoping for an opportunity. So this is just an example of a Series A RBC balanced fund. You can see it's almost 2% in fees. That's 194 bips. And you can see by paying 2%, you can lose 12% of your money a year. I'm just kidding. I'm being facetious, but you can see that this is just a balanced fund is what I'm trying to show, and it's just as volatile as any other fund. It's basically a basket of other RBC funds. You just low to medium risk, or really just buying a basket of a basket. So a fund of a fund, and you're paying 2% for that. Whereas, say, a BlackRock ETF, if I just want, say, a low duration, well, XSB, in this case, the fee is only 0.1%, right? So instead of paying 2%, I'm paying 0.1%, and that's a big difference over time. Ultimately, the knowledge base might need to be higher because you're selecting specific ETFs, but that's not necessarily true. Some ETFs are also very diversified, depending on what they are and what you're in. What I'm trying to articulate here is that over time, these archaic mutual funds, their fees just can't compete with something like an ETF in the long run. And I think what I'm trying to show on this slide is that happening. That trend is just very steady. These yellow bars, just constantly BlackRock takes share from the mutual fund industry, as ETFs in general take share from the mutual fund industry. And I think that's only going to continue. Like, they might not see it, but I mean, on $100 grand a year, you're paying them $2 grand a year. So, $1 million, you're paying $20,000 a year. Anyway, that's just the competitive set. And one of the things that we've seen, this will tie into something later, is that we've seen huge outflows from mutual funds. And a part of that is going to ETFs. We saw that on the BlackRock thing. But another part of that just going to GICs. Because rates are so much better than they have been. And so one of the things that I think is going to happen is when rates peak out and the bond market starts sniffing in that there's going to be rate cuts, and there will be at some point. It's only natural. We will see inflow from the GICs and money markets to the ETFs of the world, whether that's on the equity side, if it's risk on, or if it's on the bond side for recession fears. You'll see an inflow. And BlackRock's positioned to win on either one of those outcomes. Basically what I'm saying is that there's going to be this pent-up push into BlackRock products at some point in the future, whether there's an expansionary period over time or if there's a recessionary panic. And so I think that's very exciting, and it's something unique that BlackRock has positioned itself towards just by virtue of where it is. What else? You can see the scale that's embedded over time. So in 2012, they had about 40% margins. It's always been a very good business. And we've seen it go up to 46.8. Lately, it's contracted with the market. So as markets slowly expand over time, we should continue to see more scale. As the size of the business expands, we should continue to see slowly more scale on the operating line. And I think that's only natural over time. So what are they doing with all this cash? That, like I said, it's a pretty good business. They bought back 13% of themselves since 2012, so in the last decade. And they've also been increasing their dividend by about 17% a year. Which is also another good sign. They do have, the business gives off a lot of cash. It's just basically I'm showing that they're shareholder friendly with their cash flow. Business is fine, balance sheet's fine, and it slowly turns up over time. It's a very easy business to understand. It's very stable. While the markets might not be the actual performance in the long time horizon, it's very obvious that the business is a good one. Here you can see the organic growth. Basically here they're saying we're less in terms of standard deviation, so a measure of risk and volatility. They're actually fairly lower risk. So basically they're just a money-making machine over time. They just slowly grow, and they have less volatility relative to other asset managers. On the 9 months, it's I'd say pretty special again. Like you're seeing $13 billion in revenue, only $8.5 million billion in cost rather. So you're just getting a sick margin. You can see it's down year over year, which is the reason why I want to do the video. And it also shows the exposure to markets over time. But again, you can see it's largely, well, some of the calls will talk about technology service revenue. I mean, that's only 1.1 billion of their 13 billion. So yes, it's growing. Yay, exciting. But I mean, for the purposes of the investment, for purposes of today, you just need to know, is AUM going up and down slowly over time? And are the fees slowly going up or down over time? Now, the fees are slowly going up over time because, like I said, they're trying to push the funds to alternatives and higher yielding assets and funds than, say, that XSB that I showed, which was only a 0.1% fee. In terms of operating expenses, you can see that we're barely seeing pressure in employee comp, despite labor wages going up year over year. We've barely seen that at Blackrock. They actually cut their distribution servicing costs, so technology is getting better for them. Barely any change. It's a very simple business, right? And when your marketing is only 244 million and you're bringing in 13 billion a year, it's pretty nice. There's just so much scale here. It's just insane, especially as markets slowly appreciate over time. The only thing why I don't own it is because I'm trying to get it at a good price. And this does react, like the share price does react to when markets go down and up. So if there was a recession, technically we should see an inflow in BlackRock AUM as people move from money markets to bonds and fixed income. But at the same time, we should see the multiple contract for BlackRock because it's an equity. So we should see the business actually improve while it gets cheaper, and that's what I love. So that's what I'm hoping for with this one. And so when I like, oh my god, things are selling off, what should I buy? I think I'm gonna gravitate towards this video. Anyway, this slide just shows the impact of net inflows here, 306 billion, and market change, 735 billion. So about $1 trillion up, and you can see that the AUM's gone, say, in the last 12 months from 7.9 trillion to 9.1 trillion. What I'm just trying to show here is, again, how up, like, markets aren't even up that much year over year, but we're seeing a decent increase in assets under management, which is how they make their money. And one of the reasons why we're seeing it, starting to see an inflection, well, at least on the latest quarter in earnings again, as markets mean revert slowly over time, and eventually they do go up slowly over time. Anyway, that's what we're seeing here, and that's all I'm trying to say. With this one, on the cash flow, you can see it's just it's a beautiful thing. You can see 4.9 billion cash flow from operations. They only had to put 800 in the business, so you're basically walking away with 4 billion, of which 2.9 is going to dividends, and then they put the rest of buybacks. You can see the buybacks are actually a bit higher lately, and a part of that is because they're just using their cash on hand to increase the buybacks, specifically when they got cheaper. Like I'd argue it currently is and has been for a bit. Now it's not dumb cheap yet, but it's getting there, and they have an immaculate balance sheet, like I said. In terms of debt, or in terms of the balance sheet rather, you can see cash on hand is still 7.4. This is at December 31st. And you can see that debt was only about 6.65. Some people find financials, balance sheets to be confusing, and that is true, but this one's very, very simple. You don't have to worry too much about it. You should always see the separate account assets equal to separate account liabilities, which they do. But other than that, at the bottom line, you can see that the retained earnings just continue to trickle up because the business is profitable. And you can see the treasury stock continues to go up negatively because they're buying back shares all the time. Anyway, it's a pretty healthy balance sheet. It's a pretty predictable cash flow, and the earnings are slowly going up over time. It's where the margins scales naturally. In 2021, Q1, Q2, Q3, very strong markets, and we've seen that sell off in equities and fixed income at the same time, and so that lowers the margin. I've recently seen some of the markets appreciate, and now we've seen the market start correcting again, and now we're comping these weaker quarters still. And expectations are still for earnings to go down year over year for BlackRock, even though we already have, now we have 3 quarters of better margins, or 2 quarters rather of better margins. So it'll be funny to see how that happens. I just think expectations are low, which unfortunately means that I might not get the price I want. So it's kind of a frustrating point. But you can see the earnings per share is pretty strong. You're putting up almost put back $11 a quarter again, which would put a run rate of $44 a share in earnings power a year, which is pretty good at $660 a share, especially with the characteristics that I've mentioned thus far. In terms of fragmentation, asset management is very fragmented. They're basically, everyone thinks BlackRock is the big fish. they only own 8% of assets under management, and they've only grown that from 7% in 2016. So basically this slide is saying there's a long way to go, and versus other industries like US credit card issuers, it's very fragmented. BlackRock's saying we're only 3% of the total market, and 8% on this stack. Anyway, here is just how I view, this is called Fast Graphs. I don't think I've shown this one before. It's a new one. I've decided to enroll. You can see BlackRock last couple times. How I'd read this is every time it's hit about 15 times earnings, it's been rallying. It doesn't stay below it very long. Right now it's still, well, it's cheaper than it has been, and it's long-term average of 21 times earnings. It's only at 18 now, so it's 3 turns cheaper than normal, but I want to get it at 15. We'll just call it $80 cheaper. That would be the dream. So say if it is 636, I'd like it at like 570. I might not get there, but that would be nice. Then I'd be buying a beautiful business at a decent price, especially relative to its long-term average. Now it is technically cheaper than its long-term average, so if you're wrong to buy it here, I'd like to really buy it when everything sells off and I know this business is improving. In terms of the long term, you can see, if I were to go back to 2010, you can see $9 billion, $10 in earnings power, and now we're doing $10 in earnings power a quarter instead of a year. Getting up there again is what I'm trying to say. In the business, obviously, when you can triple your revenue or double your revenue and triple your earnings power, obviously you have pretty strong business. So anyway, why do I think that flows are going to pick up? Basically, they're saying they're seeing $7 trillion in money market funds. And I think whenever there's cash that's sitting on the sidelines that's been building up, because we've seen, what's a good slide? That power slide is a good one. So we've seen this rotation from balanced funds to GICs to money market funds to things that are not equities and not bonds, right? We haven't seen bonds really appreciate in 3 years now, which is unusual as well. So eventually that will go into BlackRock. I'll go into everything wants to be BlackRock, but BlackRock will participate in that whenever that $7 trillion in money market funds resets, right? Whenever GICs stop yielding 5 and they start resetting back down to 2, right? Or 3, which they might, right? At some point. That'll be interesting to see where that money goes, and I think BlackRock is the winner in that one. I think that's the gist of it. Here's another way to show just how base fees just pick up over time, whether it's through continued inflows through ETFs, just being superior to mutual funds, or the technology stack, which is doing well for them, the Latin, which I haven't mentioned at all, but just because for the purposes of the video for today, we don't really need to know about it. With the base business, it's just base fees, and you can see that it just grows with the market and with their superior position relative to mutual funds. But yeah, that's pretty much all I wanted to talk about with BlackRock. It's a fun one. I want this video to be a bit shorter. Yeah, basically I want to get it at 15 times earnings. And usually this business doesn't get there very long. If it does, it's very brief. So I want to be able to watch this video again, listen to myself think, and be like, okay, do it when it gets there. But yeah, anyway, I'd like to know your thoughts on BlackRock. It's a little bit obviously different than Rick's Hospitality or some of the other retailer ones that have just been getting so cheap. This is one that I really want to pick up at some point because I just think slowly over time it's just a nice business. Anyway, have a great rest of your weekend.